Hey everyone, what's up, and welcome back to the Craig Trader channel. Today we're diving into a topic that gets me fired up: how to build serious wealth, even if you're starting with just $1,000. That's right, you don't need to be rolling in dough to become a millionaire. Before we get started, make sure you hit that thumbs up button, subscribe to the channel, and smash that notification bell so you don't miss out on future videos about building wealth. And don't forget to share this video with anyone who's ready to level up their finances. Let's spread the wealth building knowledge. Now, we all know that getting rich takes time, dedication, and a solid strategy. That's why I've put together this comprehensive guide: 25 ways to become a millionaire in less than 10 years, starting with just $1,000. We'll be covering a range of investment strategies, from the stock market to side hustles, and even some alternative investments. Remember, I'm not a financial advisor, and this isn't financial advice. This is all about sharing what's worked for me and countless others who've achieved financial freedom. So buckle up, grab your notebooks, and let's get started on your journey to becoming a millionaire. Let's kick things off with the cornerstone of wealth building: compound interest. Think of it like a snowball rolling down a hill. It starts small, but as it picks up snow, it gets bigger and bigger. You earn interest on your initial investment, and then that interest earns interest. Over time, this snowball effect really adds up. That's the power of compound interest. Now, here's the thing about compound interest. The earlier you start, the more powerful it becomes. Remember that snowball analogy? The longer it rolls, the bigger it gets. Time is your greatest ally when it comes to building wealth. So don't wait to start investing. Remember, the name of the game is long-term growth. All right, so we've covered the power of compound interest. Now, let's talk about where to put your money to work. And for most people, the answer is simple: low-cost index funds, specifically those that track the S&P 500. Now, you might be wondering, what's the S&P 500? Well, it's like the all-star team of the stock market. It's a basket of 500 of the largest, most successful publicly traded companies in the US, like Apple, Amazon, and Google. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all of these companies. The beauty of index funds is that they're incredibly diversified. Instead of trying to pick individual stocks, which is risky and time-consuming, you're spreading your bets across hundreds of companies. This diversification helps to reduce risk, because if one company performs poorly, it's less likely to drag down your entire portfolio. And the best part, historically, the S&P 500 has delivered an average annual return of around 10%. That's right, 10%. Of course, past performance is not indicative of future results, but over the long term, the stock market has consistently trended upwards. Now, when it comes to index funds, it's crucial to choose low-cost options. These are funds with low expense ratios, which are basically the fees you pay to the fund manager. Every dollar you pay in fees is a dollar that's not working for you. Fortunately, there are plenty of low-cost index funds available. For every $10,000 you invest, you're only paying $3 in fees per year. That's a steal compared to some actively managed funds. Studies have shown that most actively managed funds fail to beat the market. Stick with low-cost index funds, especially those tracking the S&P 500. Remember, slow and steady wins the race. All right, let's talk about dividend growth stocks. Now, you might be thinking, dividends? Isn't that what old people invest in? But listen, dividends can be a powerful tool for building wealth. Think of it like this. Dividends are like getting paid to own a piece of a company. You're literally sharing in their profits just for being an investor. When you reinvest those dividends, you're buying more shares. And as you accumulate more shares, you earn even more dividends. It's like a snowball effect, your money growing exponentially. This is the beauty of compounding in action. Remember, time is your greatest asset when it comes to investing. So, how do you find these magical dividend-paying companies? Well, it's all about doing your research. Look for companies with a history of increasing their dividends year after year. This shows that they're profitable and committed to rewarding their shareholders. A good place to start is with established companies in sectors like consumer staples, healthcare, and utilities. These industries tend to be more resilient during economic downturns. Check out their dividend payout ratio. A lower payout ratio is generally better. Look at their debt levels. Stick with companies that have a healthy balance sheet. There are plenty of online resources and stock screeners. Websites like Yahoo Finance, Google Finance, and Robinhood can help you. Just remember, investing always involves some level of risk. Diversify your portfolio and be prepared to hold your investments for the long haul. Now let's talk about real estate. Buying physical property can be expensive and time-consuming. That's where REITs come in. REITs, or real estate investment trusts, let you invest in real estate without owning properties. Think of it like buying a tiny piece of a shopping mall, office building, or apartment complex. They collect rent and distribute profits as dividends. REITs must pay out at least 90% of their taxable income as dividends. That means a steady stream of passive income for you. So, why should you consider adding REITs to your portfolio? They offer diversification beyond traditional stocks and bonds. Real estate can act as a hedge against market volatility. REITs provide high dividends and passive income. Plus, there's potential for long-term capital appreciation. Remember, all investments come with risks. Diversify across sectors and locations. Adding REITs can enhance returns and build a resilient strategy. Let's be real. Relying solely on your 9-to-5 job might not be enough. That's why it's crucial to explore additional income streams. And what better way to do that than by starting a side business? A side hustle doesn't have to consume your life. It can be something you're passionate about. What are you good at? What do you enjoy doing in your free time? Can you turn that passion into a profitable venture? The beauty of a side hustle is that it puts you in the driver's seat. You have the flexibility to set your own hours and choose your clients. Now here's the key to turning your side hustle profits into serious wealth. Reinvestment. Remember the power of compound interest we talked about earlier? The same principle applies here. Reinvest your side hustle profits into income-generating assets like dividend stocks, REITs, or back into your business. You create a snowball effect that can supercharge your wealth-building journey. By combining compound interest with your side hustle income, you'll achieve financial freedom. Now let's dive into a potentially lucrative avenue that can deliver some serious returns, peer-to-peer lending, or P2P for short. Essentially, it's like cutting out the middleman, the big banks, and and connecting borrowers directly with investors like you. Think of platforms like Lending Club or Prosper. You're essentially acting as the bank, lending money to individuals who need it for various reasons. Maybe it's consolidating debt, funding a home improvement project, or even starting a small business. Now, here's where it gets interesting, because you're lending directly, you can often score significantly higher interest rates compared to traditional savings accounts or even CDs. I'm talking potentially double-digit returns, which can make a huge difference in how quickly your money grows. But, and this is a big but, it's crucial to remember that higher returns often come with higher risks. We'll delve into those risks in just a bit, but first, let's explore how P2P lending actually works and what you need to know before taking the plunge. With P2P lending, you're not lending to a giant corporation. You're lending to individuals. And just like with any loan, there's always a chance that the borrower might default. That's why it's crucial to do your due diligence, assess the borrower's creditworthiness, and diversify your investments. Don't put all your eggs in one basket, or in this case, one borrower. Spread your investments across multiple loans to mitigate the impact of potential defaults. Think of it like building a diversified stock portfolio. You wouldn't put all your money into a single stock, right? Another thing to remember is that P2P lending isn't as liquid as, say, selling stocks. It might take some time to sell your loans on the secondary market if you need to access your cash quickly. So it's generally not a good idea to invest money you might need in the short term. That being said, if you're looking for potentially higher returns and are comfortable with a bit more risk, P2P lending can be a valuable addition to your investment strategy. Just remember to do your research, diversify wisely, and go in with your eyes wide open. Now, let's talk about a topic that's been creating quite the buzz lately: cryptocurrencies. You've probably heard of Bitcoin, Ethereum, and maybe even Dogecoin, but what are they exactly? And how can they potentially help you on your journey to becoming a millionaire? In a nutshell, cryptocurrencies are digital or virtual currencies that use cryptography for security. They're decentralized, meaning they aren't controlled by any government or financial institution. This has made them incredibly popular as they offer a level of freedom and anonymity that traditional currencies can't match. But here's the thing, cryptocurrencies are also incredibly volatile. Their prices can fluctuate wildly, sometimes swinging by double-digit percentages in a single day. This volatility can be nerve-wracking for some investors, but for others, it presents an opportunity to potentially make significant profits. Just remember, as with any investment, it's crucial to understand what you're getting into before diving headfirst. The allure of cryptocurrencies lies in their potential for exponential growth. Just look at Bitcoin, for example. In 2010, a single Bitcoin was worth less than $1. Today, it's trading at thousands of dollars, even after experiencing some significant dips. That kind of growth potential is simply unheard of in traditional markets, but it's important to remember that past performance is not necessarily indicative of future results. The crypto market is still relatively young and unpredictable, and there's no guarantee that any particular cryptocurrency will continue to rise in value. However, if you're willing to stomach the volatility and do your research, Investing in cryptocurrencies can be a way to potentially supercharge your portfolio. Just remember to start small, diversify across different cryptocurrencies, and only invest what you can afford to lose. And as always, it's crucial to stay informed. The crypto landscape is constantly evolving, with new cryptocurrencies and blockchain projects emerging all the time. So, keep learning, stay updated, and remember that knowledge is your most powerful asset in this exciting but volatile market. Now let's shift gears and talk about a more diversified approach to investing in high growth sectors, exchange traded funds, or ETFs. Think of ETFs like baskets of stocks that track a particular index, sector, or theme. For example, instead of trying to pick individual stocks in the tech sector, you could invest in a tech ETF that holds shares of companies like Apple, Microsoft, and Amazon. This diversification helps spread your risk and can potentially lead to more stable returns compared to investing in individual stocks. But here's what's really exciting about ETFs. You can find ETFs that focus specifically on high growth sectors like technology, healthcare, renewable energy, and more. These sectors are known for their innovation and potential for rapid growth, which can translate into significant returns for investors. So how do you choose the right high growth ETFs for your portfolio? Let's explore some key factors to consider. When evaluating high growth ETFs, look beyond past performance. Focus on the ETF's holdings, expense ratios, and strategy. Examine the ETF's portfolio. What companies does it hold? Are these companies industry leaders? Do they have a solid growth track record? These insights reveal the ETF's potential. Pay attention to the expense ratio. Small differences can impact returns. Choose low expense ratio ETFs. Consider the ETF's strategy. Actively managed ETFs may offer higher returns. Passively managed ETFs track an index with lower fees. Diversify across multiple ETFs to mitigate risk and maximize success. All right, let's dive into the world of stock options. Options, that sounds risky, and you know what? You're not wrong. Options trading can be risky, but also rewarding if you know what you're doing. Options give you the right, but not the obligation, to buy or sell a stock at a specific price. Instead of buying shares, you could buy a call option. If the stock goes up, your option becomes more valuable. But if it goes down, you could lose your initial investment. Options can offer leveraged returns, but with higher potential reward comes higher risk. Now, let's talk about some basic options trading strategies. One popular strategy is called a covered call. This involves selling a call option on a stock you already own. It's like renting out your stocks for a premium. If the stock price stays below the strike price, you get to keep the premium and your shares. And if the stock goes above the strike price, the buyer might exercise it, meaning you'd have to sell your shares. And another strategy is buying a put option. This gives you the right to sell a stock at a certain price, even if it drops below that price. If the stock goes down, your put option becomes more valuable. Options trading is best suited for experienced investors. If you're new, stick to straightforward strategies like index funds or dividend stocks. Ever dreamed of getting in on the ground floor of the next Amazon or Google? Well, investing in startups might just be your ticket. Now, I'm not talking about quitting your job and pouring your life savings into your friend's cousin's app idea. I'm talking about strategically investing small amounts of capital into promising startups through platforms like Seed Invest or Start Engine. See, startups have the potential for massive growth. I mean, Just look at companies like Uber or Airbnb. Early investors in those companies made absolute fortunes. But here's the catch. Investing in startups is inherently risky. Most startups fail, and there's a good chance you could lose your entire investment. That's why it's crucial to diversify and only invest money you can afford to lose. Now, before you go throwing your money at every shiny new startup you come across, let's talk about how to evaluate potential investments. First and foremost, do your research. Look at the company's team, their product or service, their target market, and their competition. You want to see a strong team with a unique product or service that solves a real problem in a large and growing market. It's also important to look at the company's financials, their revenue model, and their burn rate. You want to make sure they have a solid plan for generating revenue and that they're not burning through cash too quickly. Another important factor to consider is valuation. Early stage startups can be difficult to value, so it's important to do your due diligence and make sure you're not overpaying for your investment. Look at comparable companies in the same industry and see how their valuations stack up. Finally, remember that investing in startups is a long-term game. It can take years, even a decade or more, for a startup to reach its full potential. So, be prepared to be patient and to ride out the ups and downs of the startup world. All right, let's talk about real estate. It's been a proven wealth building tool for decades, but traditionally, it's been out of reach for many people. You need a lot of capital, good credit, and the stomach to deal with tenants, toilets, and everything in between. But here's the exciting part. Real estate crowdfunding is changing the game. Platforms like Fundrise and Realty Mogul are making it possible for anyone to invest in real estate with as little as a few $100s. And you can invest in individual properties or diversified portfolios of properties, all from the comfort of your own home. It's like owning a tiny piece of a skyscraper or a shopping mall without the hassle of being a landlord. Now, real estate crowdfunding isn't a get-rich-quick scheme. It's still a long-term investment, but it can offer the potential for passive income through rental payments and appreciation in property value. So, how do you get started with real estate crowdfunding? Well, first things first, you need to choose a platform. There are many reputable platforms out there, each with its own fees, minimum investment requirements, and investment options. Do your research, read reviews, and compare different platforms before making a decision. Once you've chosen a platform, it's time to start browsing investments. Look for properties or portfolios that align with your investment goals and risk tolerance. Some platforms focus on residential properties, while others specialize in commercial real estate. Some offer debt investments, which are generally lower risk, but also offer lower returns, while others offer equity investments, which have higher potential returns, but also come with higher risk. Before you invest in any property or portfolio, it's crucial to read the offering documents carefully. These documents will outline the investment strategy, the risks involved, and the fees associated with the investment. Make sure you understand everything before you commit any capital. Remember, like any investment, real estate crowdfunding comes with risks. The real estate market can be cyclical, and property values can go down as well as up. It's essential to diversify your investments and to invest for the long term. Now let's talk about a strategy that can be your best friend when it comes to navigating the stock market roller coaster, dollar cost averaging. It's like setting your investments on autopilot, and it's a total game changer, especially if you're just starting out. Here's the deal. Instead of trying to time the market perfectly, which, let's be honest, is almost impossible, even for seasoned investors, you invest a fixed amount of money at regular intervals. It could be every week, every month, whatever works best for you. Think of it like putting a set amount of money into your investments every time you get paid. Now, you might be thinking, what's so special about that? Well, here's the beauty of it. When the market dips and prices are low, you're buying more shares. And when the market is riding high, you're buying fewer shares. Over time, this strategy helps you average out the cost of your investments, potentially boosting your returns in the long run. Think of it like buying your favorite coffee. If the price suddenly drops, you're stoked, right? You buy more because you're getting a better deal. Dollar cost averaging works the same way with your investments. When prices are down, you're scooping up those shares at a discount. And on the flip side, when the market is soaring and everyone's caught up in the hype, dollar cost averaging prevents you from going all in at potentially inflated prices. Remember, what goes up must come down, and you don't want to be caught holding the bag when it does. This approach is all about taking the emotion out of investing. It's easy to get caught up in the fear and greed cycle of the market, but dollar cost averaging helps you stay disciplined and focused on your long-term goals. So whether you're just starting out with a small amount of money or you've been investing for a while, dollar cost averaging is a powerful strategy that can help you build wealth steadily and potentially minimize your risk. Remember, consistency is key in the investing game. All right, let's switch gears and talk about a more conservative but still incredibly important investment strategy: high interest savings accounts. Now, I know what you're thinking, savings accounts? Really, Graham? But hear me out, because these aren't your grandma's savings accounts. We're talking about high yield savings accounts offered by online banks and financial institutions. These accounts typically offer significantly higher interest rates compared to traditional brick and mortar banks, and in this economy, every percentage point counts. While these accounts might not make you a millionaire overnight, they play a crucial role in building a solid financial foundation. They're perfect for storing your emergency fund, saving up for a down payment on a property, or parking your cash while you wait for investment opportunities. Now, if you're looking for a slightly less liquid but potentially higher yielding option, certificates of deposit or CDs might be worth considering. CDs are like time deposits where you lend money to a bank for a fixed period, typically ranging from a few months to several years. In return, you earn a fixed interest rate, which is usually higher than what you get with a regular savings account. The trade-off is that you generally can't access your money before the CD term matures without incurring penalties. But hey, sometimes a little bit of forced savings can be a good thing, right? Remember, building wealth is a marathon, not a sprint, and having a mix of investments, including some lower risk options like high yield savings accounts and CDs, can provide stability and peace of mind. Plus, it's always good to have some dry powder ready to deploy when opportunity knocks. All right, guys, let's dive into the exciting world of angel investing, where you have the potential to be an early backer of the next Google or Amazon. Now, before you jump in head first, it's important to understand both the incredible opportunities and the risks involved. Angel investors are essentially individuals who provide capital to startups or entrepreneurs in exchange for equity ownership in the company. It's like being a shark on Shark Tank, but in real life and potentially with a lot less drama. Now, why would you want to become an angel investor? Well, the potential returns can be astronomical. Imagine investing a relatively small amount of money in the early stages of a company that goes on to become a global phenomenon. That's the kind of life-changing wealth creation that angel investing can offer. However, it's crucial to remember that angel investing is not for the faint of heart. It's a high-risk, high-reward game. The vast majority of startups fail, and as an angel investor, you need to be prepared to lose your entire investment. That's why it's crucial to do your due diligence, spread your investments across multiple companies, and only invest money that you can afford to lose. Don't put your rent money or your emergency fund into a risky startup, no matter how promising it seems. But if you're willing to embrace the risk and put in the work, angel investing can be an incredibly rewarding experience, both financially and personally. You'll have the opportunity to support innovative ideas, work with passionate entrepreneurs, and potentially be a part of something truly groundbreaking. Remember, always do your research, consult with financial advisors, and make informed decisions based on your risk tolerance and financial goals. All right, let's talk about rental properties. I know what you're thinking. Graham, that's not a quick way to get rich. But listen, done right, rental properties can generate some serious passive income, and that's what we like. Imagine this. You're collecting rent checks every month without lifting a finger. That's the beauty of being a landlord. Plus, you're building equity in an asset that historically appreciates in value. It's a long-term play, but a solid one. Now, I'm not saying it's all sunshine and rainbows. Being a landlord comes with its own set of challenges, like dealing with tenants and property maintenance. But with the right systems in place, you can minimize those headaches and maximize your returns. And here's the kicker. As you build equity in your rental properties, you can leverage that equity to buy more properties. It's like a snowball effect, and over time, your rental income can grow exponentially. So, how do you get started? First, do your research. Look for areas with strong rental demand and potential for appreciation. You can use online tools like Zillow or Redfin to get an idea of rental rates and property values. Next, crunch the numbers. Calculate your potential cash flow by subtracting expenses like mortgage payments, property taxes, and insurance from your rental income. Remember, cash flow is king in real estate. Once you've found a promising property, it's time to secure financing. Now, getting a mortgage for a rental property is a bit different than getting one for your primary residence. You'll typically need a larger down payment and a higher credit score. But don't let that discourage you. There are plenty of resources available for first-time real estate investors. And with the right preparation, you can make your rental property dreams a reality. Now let's talk about a concept that's absolutely crucial to building wealth compound gains. It's like a snowball rolling downhill, gaining momentum and size as it goes. The key is to reinvest your earnings, letting them compound over time. Think of it this way: if you invest $1,000 and earn a 10% return, you'll have $1,100. Not bad, right? But if you reinvest that $1,100 and earn another 10%, you'll have $1,210. See how that extra $10 makes a difference? That's the power of compounding. The longer you let your money work for you, the more it grows. It's like magic, but instead of wands and spells, it's all about discipline and patience. Now, I know it can be tempting to spend your investment gains, especially when you're starting out. But trust me, the sooner you start reinvesting, the faster your wealth will grow. And that's what we're all about, right? So, how do you put compound gains to work for you? It's simple. Reinvest your earnings. Whether it's dividends from stocks, interest from bonds, or rental income from properties, put that money back into your investments. Remember those dividend growth stocks we talked about earlier? Reinvesting those dividends is like adding fuel to the fire, accelerating your returns even further. And the best part is, many brokerage accounts offer automatic dividend reinvestment plans, making it effortless. But it's not just about dividends. Reinvest your capital gains too. If you sell an investment for a profit, consider putting those profits back to work in other promising opportunities. The key takeaway here is this: focus on growing your principal, not just generating income. By consistently reinvesting your earnings, you harness the power of compound gains and put your money on autopilot to build wealth over the long term. Let's talk about taxes, guys. No one likes paying them, right? The good news is there are legal ways to reduce your tax burden and keep more of your hard-earned money working for you. I'm talking about tax-advantaged accounts. These accounts, like 401ks and Roth IRAs, are specifically designed to help you save for retirement and potentially lower your tax bill. They offer unique tax benefits that can significantly boost your investment returns over time. For example, with a traditional 401k, your contributions are tax deductible, meaning you lower your taxable income in the present. And with a Roth IRA, your withdrawals in retirement are tax-free. That's right, you won't owe a dime in taxes on those gains. Now, the specific rules and contribution limits for these accounts can get a little complex, so I highly recommend doing your research or consulting with a financial advisor to determine which options are best for you. But trust me, maximizing your use of tax-advantaged accounts is one of the smartest financial moves you can make. It's like getting a bonus from the government on your investments. If your employer offers a 401k match, contribute at least enough to get the full match. It's free money, people. Don't leave that on the table. And even if you're self-employed, you can still open a solo 401k and enjoy similar tax benefits. With a Roth IRA, you're essentially paying taxes up front on your contributions, but your withdrawals in retirement are tax-free. This can be especially advantageous if you expect to be in a higher tax bracket during retirement. Remember, tax-advantaged accounts are your secret weapon in the fight against taxes. By taking advantage of these accounts, you can keep more of your money working for you and accelerate your journey to financial freedom. Now, let's talk about a strategy that takes a bit more research and due diligence, but can be incredibly rewarding: buying undervalued stocks. This is where you're essentially playing the role of a financial detective, looking for companies that the market might be mispricing. You see, the stock market isn't always perfectly efficient. Sometimes a company's true value might be higher than what its stock price reflects. This could be due to a variety of factors like temporary bad news, industry headwinds, or simply market sentiment. This is where you come in. By carefully analyzing a company's financials, understanding its business model, and looking at its future prospects, you can identify these hidden gems. Think of it like finding a scratch-off lottery ticket for just $1, but instead of hoping for a win, you're using your knowledge and analysis to uncover its true value. However, remember, this isn't about chasing quick flips. This is about finding solid companies with strong fundamentals that are temporarily undervalued. It's about being a long-term investor, buying when everyone else is fearful, and potentially reaping the rewards when the market catches up to its true potential. So how do you actually find these undervalued companies? Well, there are a few key metrics you can look at. One popular one is the price to earnings ratio, or PE ratio. This compares a company's stock price to its earnings per share, giving you an idea of how much investors are willing to pay for each dollar of profit. Another important metric is the price to book ratio, or PB ratio. This compares a company's stock price to its book value, which is essentially the value of its assets minus its liabilities. A low PB ratio could indicate that a stock is undervalued. Of course, these are just two of many metrics to consider. You'll also want to look at things like a company's debt levels, cash flow, and management team. And don't forget to read their annual reports and understand their competitive landscape. Finding undervalued stocks takes time, research, and patience. But if you're willing to put in the work, it can be a highly rewarding way to build wealth over the long term. Remember, you're not just buying stocks, you're investing in businesses. All right, now let's shift gears and talk about high growth mutual funds. These are like diversified baskets of stocks that are specifically chosen for their potential to grow at above average rates. Think of it like investing in a team of talented sprinters, all aiming for the finish line of high returns. High growth mutual funds typically focus on companies in sectors that are experiencing rapid innovation and expansion. This could include areas like technology, healthcare, renewable energy, or even emerging markets. These companies are often characterized by their potential for rapid revenue growth, even if they're not yet turning a huge profit. Now, the key thing to remember about high growth mutual funds is that they come with higher risk. These companies are still in their growth phase, which means their future success isn't guaranteed. They might face competition, regulatory hurdles, or even just the challenges of scaling their business. That being said, high growth mutual funds also offer the potential for higher returns. If you're comfortable with a bit more volatility and you're investing for the long term, these funds can be a great way to turbocharge your portfolio's growth. So, how do you go about choosing the right high-growth mutual fund for your portfolio? Well, just like with any investment, it's crucial to do your due diligence. Start by looking at the fund's track record. How has it performed in both bull and bear markets? Next, take a close look at the fund's expense ratio. This is the annual fee you pay to the fund manager, and it can eat into your returns over time. Look for funds with reasonable expense ratios, ideally below 1%. It's also important to consider the fund's investment strategy. What types of companies does it invest in? What's its risk tolerance? Make sure the fund's approach aligns with your own investment goals and risk appetite. Finally, don't put all your eggs in one basket. Just like with individual stocks, it's important to diversify your mutual fund holdings. Consider investing in a mix of high-growth funds across different sectors and geographies to spread your risk and potentially maximize your returns. We've talked about a lot of different investment strategies so far, from index funds to real estate to even flipping websites. But the truth is, the absolute best investment you can ever make is in yourself. Think about it. Every dollar you earn, every investment you make, every financial decision you ever have to make, it all stems from your knowledge, skills, and ability to generate income. Now, investing in yourself doesn't necessarily mean spending a ton of money. It could be as simple as reading books, listening to podcasts, or taking free online courses. There are countless resources available today that can teach you everything from financial literacy to coding to marketing to anything else you can imagine. The key is to be a lifelong learner. Continuously seek out new knowledge, develop valuable skills, and expand your horizons. Remember, the more you know, the more you grow, and the more opportunities you unlock for yourself. So, what specific skills should you focus on developing? Well, that depends on your interests and career aspirations. But there are a few areas that are universally valuable in today's job market. For starters, having strong financial literacy is crucial no matter what you do. Understanding how money works, how to budget, save, invest, and manage debt is essential for building a secure financial future. Technical skills are also in high demand. Learning to code, understanding data analysis, or mastering digital marketing can open doors to a wide range of high-paying careers. But don't underestimate the power of soft skills either. Communication, problem solving, critical thinking, and teamwork are all highly valued by employers across industries. These are the skills that help you navigate the complexities of the workplace, build strong relationships, and ultimately advance in your career. Remember, investing in yourself is a continuous journey, not a one-time event. So make a commitment to lifelong learning, embrace new challenges, and watch as your knowledge and skills become your most valuable assets. All right, guys, let's dive into the world of private equity and venture capital. Now, this is where things get a little more complex and definitely higher risk. But hey, higher risk, higher potential reward, right? Private equity firms essentially pool money from wealthy individuals and institutions to buy, improve, and eventually sell companies for a profit. Venture capital is similar, but they specifically focus on early stage, high growth companies, think tech startups with the potential to be the next Amazon or Tesla. Now, these investments are not for your average investor, They usually require a high minimum investment, often hundreds of thousands or even millions of dollars. Plus, your money is locked up for several years, so you need to be comfortable with that level of illiquidity. But if you've got the capital and the risk tolerance, the potential returns can be astronomical. I mean, we're talking about returns that can significantly outperform the stock market. But remember, always do your thorough due diligence before jumping in. Now, you might be thinking, Graham, I don't have millions lying around to invest in private equity. And you know what? Most people don't. But there are ways to get in the game with smaller amounts. One option is through platforms like Fundrise or Equity Multiple. These platforms allow you to invest in real estate or private equity projects with significantly lower minimums, sometimes even starting at just a few $1,000s. Another way is through certain ETFs or mutual funds that specialize in private equity or venture capital investments. These can offer more diversification and liquidity compared to direct investments, though the potential returns might be slightly lower. Remember, private equity and venture capital are long-term, illiquid investments. You're essentially betting on the expertise of the fund managers to pick winners. So do your research, choose wisely, and don't put all your eggs in one basket. All right, moving on to something a little different. Flipping websites and domains. Think of it like flipping houses, but in the digital world. You buy undervalued websites or domains, improve them, and then sell them for a profit. The beauty of this strategy is that it's highly scalable. Now, you don't need a ton of capital to get started, and you can do it from anywhere in the world with an internet connection. Plus, the demand for online businesses is only growing, so there's a huge potential market out there. Now, there are two main approaches here. You can either buy an existing website with some traffic and revenue, or you can start from scratch by buying a catchy domain name and building a website around a profitable niche. The key is to identify undervalued assets with potential. Look for websites with solid traffic but poor monetization, or domains that are short, memorable, and relevant to a profitable industry. Once you've acquired a website or domain, it's time to roll up your sleeves and get to work. If you're starting from scratch, you'll need to build a website, create valuable content, and attract traffic. If you're buying an existing site, focus on improving its design, content, and SEO to increase traffic and revenue. Remember, the goal here is to create a valuable asset that someone else will be willing to pay a premium for. Once you've built up the website's traffic, revenue, and overall authority, you can list it for sale on platforms like Flippa or Empire Flippers. Now, like any investment, flipping websites and domains comes with its own set of risks. You need to be comfortable with website development, SEO, and online marketing. And there's always the chance that your website won't take off or that you won't be able to sell it for a profit. But if you're willing to put in the work and learn the ropes, flipping websites and domains can be a lucrative way to build wealth. And hey, who knows, you might even stumble upon the next Google or Facebook in the process. Let's face it, not everyone has the time or desire to actively manage their investments. I mean, we've got lives to live, right? That's where the beauty of automation comes in. Automating your investments is like putting your wealth building journey on autopilot. It takes the emotion out of investing, ensures consistency, and frees up your time to focus on other things like your side hustle or just enjoying life. Now, there are a few different ways to automate your investments. One popular option is using robo-advisors like Betterment, Wealthfront, or Acorns. These platforms use algorithms to create and manage a diversified portfolio based on your risk tolerance and financial goals. They handle everything from asset allocation to rebalancing and even tax loss harvesting. Plus, they typically have lower fees compared to traditional financial advisors. Another way to automate your investments is through your brokerage account. Most major brokerages offer features like automatic investment plans, where you can set up recurring deposits from your checking account to your investment account. You can also set up automatic purchases of specific stocks or ETFs, ensuring that you're consistently investing in the assets you believe in. And don't forget about dividend reinvestment plans, or DRIPs, which automatically reinvest your dividends to buy more shares, compounding your returns over time. The key to successful automation is to set it up right and then let it do its thing. Choose a reputable robo-advisor or brokerage, set up your automatic investments, and resist the urge to constantly tinker with your portfolio. Remember, time in the market is often more important than timing the market. Automating your investments is one of the easiest and most effective ways to build wealth over time. It takes the stress out of investing, ensures consistency, and allows you to focus on other important aspects of your life. So, why not put your wealth building on autopilot and watch your money grow? Now, I know what you're thinking. Debt, isn't that a bad thing? And you're right, debt can be dangerous if not used responsibly. But hear me out. There's good debt and bad debt. Bad debt is that high-interest credit card debt you rack up buying things you don't need. Good debt, on the other hand, is using debt strategically to acquire assets that will appreciate in value. Think about it. How do most people buy real estate? They take out a mortgage. They're using leverage, borrowing money to acquire an asset that will hopefully go up in value. Now, leverage can be a double-edged sword. If the value of your asset goes down, you're still on the hook for that debt, and you could lose more than your initial investment. That's why it's crucial to be smart about it. Do your research, understand the risks involved, and never invest more than you can afford to lose. But done correctly, using leverage can amplify your returns and help you build wealth faster. So, what are some ways you can use leverage responsibly? One way is through margin trading. This allows you to borrow money from your broker to buy more stocks, ETFs, or other securities. This can amplify your gains, but remember, it can also magnify your losses. Another option is using a HELOC, a home equity line of credit, to invest in real estate. Say you have a rental property that's gone up in value. You can tap into that equity with a HELOC and use that money to buy another property. Of course, you'll want to ensure the numbers make sense and factor in things like interest rates and vacancy rates. Remember, leveraging debt isn't for everyone. It's crucial to have a solid financial foundation, a high risk tolerance, and a deep understanding of the investments you're making. If you're unsure, it's always best to consult with a financial advisor before making any decisions. Look, I get it. We live in a world of instant gratification. We want everything now, and we want it fast. But when it comes to building wealth, patience is key. Remember, Rome wasn't built in a day, and neither is $1 million portfolio. It takes time, discipline, and consistency to achieve your financial goals. Think of it like planting a tree. You plant the seed, you water it, you nurture it, and you wait. You don't dig it up every few days to see if it's grown. You trust the process, you stay consistent with your care, and eventually that tiny seed grows into a strong, fruitful tree. The same principle applies to investing. You need to plant your seeds, which are your investments, and give them time to grow. Don't get discouraged by short-term market fluctuations or panic sell when things get tough. Remember, the stock market is a marathon, not a sprint. There will be ups and downs along the way. That's just the nature of the market. There will be times when your portfolio is soaring high and you feel like a financial genius. And there will be times when the market takes a dip and you start to question everything. But it's during those times of uncertainty that it's more important than ever to stay the course. Remember why you started investing in the first place. Was it to achieve financial freedom, to retire early, to leave a legacy for your family? Whatever your why is, keep it at the forefront of your mind, especially when things get tough. Don't make rash decisions based on fear or emotion. Stick to your investment plan. Keep investing consistently, and remember, time is your greatest ally. The longer you stay invested, the more time your money has to compound and grow exponentially. So, be patient, stay the course, and trust the process. There you have it. 25 powerful ways to become a millionaire in less than 10 years, starting with just $1,000. Now remember, this isn't a get-rich-quick scheme. Building wealth takes time, effort, and a willingness to learn and adapt. But the rewards are more than worth it. Imagine a life where you have the financial freedom to pursue your passions, spend time with loved ones, and make a real difference in the world. That's the power of investing, and it's all within your reach. If you enjoyed this video, don't forget to smash that like button, subscribe to the channel for more wealth building content, and hit that notification bell so you never miss an upload. And hey, if you're ready to take your investing journey to the next level, check out the link in the description below and grab a copy of my Kindle book, Get Rich by Investing. It's packed with even more strategies, tips, and insights to help you achieve your financial goals. Here at CraigTrader, we're all about empowering you to take control of your financial future.